Hello guys, the best way to make money, the lazy way, with less risk is to go for ETFs, which is exchange traded funds. Now why is that? Because an ETF, it is like a stock. It tracks an index, whatever is this index. Let's say, for example, Dow Jones or S&P 500 or Russell 2000 or any other sector or industry ETF. Because why is that? Whenever this ETF goes up, just leave it. So you can leave it for a few weeks, few months, and you will see if this is in the right direction. For example, if you see that this ETF is going up, just leave it. This is the best way to make money without doing like day trading. It means you always trade daily. So you can accumulate money by only buying one time. I understand there is probability in that. Let's say, for example, the stock that you bought or the ETF that you bought, just you bought it and then it goes down. This, you should eliminate this ETF or stock right away. Okay? So here I'm speaking about the beginning, what we call the initial stop loss. It means whatever investment you are doing, like mostly trading, you should not leave a loser at the first time when you buy it. For example, you buy a stock today, few days it goes down, you have stop loss, you exit this. Now why you exit? Because at the beginning it was bad. If you stay more and more and more, you don't know, maybe it's going more and more down and then you lose a lot of money. And this is the cause why almost all beginners, they lose a lot of money. Instead of losing $100 or $200, you are going to lose thousands of dollars. You put 5,000 and you see that 1,002 is already gone. And you say to yourself, oh, it might go up again. And you begin to look, for example, for TV, for videos of some people, and they tell you, oh, wait, it's a good company, just wait and just wait. Okay? There is no way you should wait with losers. I'm speaking here about the first initial stop loss. Okay? Now, even for investing, if you know a company that it is so excellent, when you buy it, be careful. Okay? Be careful in not letting your stock go so down. Because when you put 5,000 or 10,000, 20,000 in a company, and then you lose a lot of money, and you stay longer and longer, and this will never help you. So the best way to do this is to buy on time, on momentum, and all my strategies shows you where to buy on momentum. Now the second thing, when we speak about ETFs, okay, why we say less risk? Less risk, it means that an ETF, it tracks an index. Let's say the index is Dow Jones. You know, Dow Jones, we have 30 stocks. So the average of this, all these 30 stocks, it gives you the price, okay, of this ETF. Now, you will have less risk because if you go, for example, to Dow Jones, we have 30 stocks. You go inside, to see all these 30 stocks and you check them one by one. Okay? Suppose that you choose one stock. Now the risk here is a lot compared to the index. Why? Because a stock might go down. Okay? It might go up also. But an index, it's the average of all stocks. So when you get the average, you have less risk in terms of risk management. And this is why a lot of my students, they use, for example, they don't use stocks, they don't search for stocks, but they search for ETFs. Okay, so it's the same thing. It's just for those who are who like less risky things to do, they should use ETFs, which is better in terms of risk. Now, understand that what's the difference between ETFs and buying stocks. It means a stock. It means you buy a company. Let's say you buy Facebook or Twitter or Apple or Google or whatever stock, Tesla or any other stock. Understand that the risk is high. Now, the risk is high. Yes, you can make a lot of money and you can lose a lot of money. But if you buy, for example, the index, your risk will be limited. And for those who don't like risk and they don't like to lose a lot, the best way is to use ETFs. Okay, so thank you very much for watching this video. Please share my video, subscribe if you don't. Thank you very much and see you tomorrow.